What a year it's been. The Sensex is up 30% over the last 12 months. Bitcoin up 200%. Even pets are getting in on the party, with over $50 million of funding in the last year into the pet industry. Despite these achievements, we really do believe that the party is just getting started. So let's talk a little bit about that. John Chambers, who participated in the building of the internet's infrastructure while as the CEO of Cisco, once said that the two equalizers in the world were internet and education. More recently, he said that if there were two countries he would bet on in Asia, it would be India twice. I think that's quite telling and exciting about where we're headed. Over the next 45 minutes, we're going to walk you through the story of India from over the last year, and we're going to end at the end with a little bit of dreaming about what if and what could happen in the future. 2021 really was a landmark year for the startup ecosystem, and I'm going to start by talking a little bit about the market. We grew tech unicorns at a record pace. In 2010, it took us 120 months to create 40 unicorns. We created 40 unicorns in 2021 in just 11 months. It took us about 2.5 years to do it, the fastest unicorn, back in 2010. In 2021, that happened in under 6 months. And today, about 22% of the companies worth $1 billion or more are in the private market, which means that over the coming years, we're going to see all of that come into the public markets and create great liquidity and opportunity for public investors. Now, last year we talked about the fact that things in India operate on Indian Standard Time, and things happen gradually, then suddenly. And that's what it's been like for exits. If you look at it, over the 4-year period from 2016 to 20, we created $23.5 billion of liquidity. But the majority of that, 75% of it, was concentrated in 4 companies. This year, the $500 million or so of exits that we've created has come in a much more distributed manner, with one company making up, with the largest company making up only 25% of that. Now, IPOs are another area that are really important for us as investors, and that we look to for generating liquidity. Until March 21, the 4 or 5 companies in the digital space that were public made up about $11 billion of equity value. By November, we saw another $53 billion come into the public markets through new listings and new IPOs. By the end of this fiscal year, we should get to about $100 billion. Now, that's new, exciting, and fantastic for public investors. Thankfully, we've also been able to participate in that. Over the course of this year, our company Truecaller went public, albeit on a foreign exchange, on the Nasdaq Stockholm, the Swedish stock exchange, on the Swedish Nasdaq exchange. And Droom, our company in the used auto space, should go public early next quarter. Now, given all this liquidity that seems to be coming in, we had to ask the question of, is there going to be more growth? Are we overvalued? Are we over-indexed to tech? And so, if you bear with me for a second, I'm going to walk you through why we believe there's tremendous headroom. Digital companies, the companies of the new age, tech businesses, represent about 8% of GDP. Now, however, on the market cap basis, they're only 0.5% of the overall market cap. Now, this 8% of GDP, were it to translate into market cap, should be about $212 billion. But today, as I mentioned on the previous slide, we were at $15 billion in March of this year. We've added another $53 billion. That means that we have over $140 billion worth of equity left to be created in the public markets. That's why we believe that the party is really just getting started. Now, add to this the fact that over time, that 8% is going to increase as tech companies start to contribute more to GDP. And we've seen that transition take place in the US, where from 2010 to 2020, we saw the overall market value of the top 10 businesses go from $2.1 trillion to $9.7 trillion. But what was even more interesting was that the mix went from 25% tech to over 80% tech. Meanwhile, in India, we found that from 2010 to 2020, overall market value of the top 10 companies did go up. However, it remained just tech. Now, that's changing. We saw that in 2016 when Reliance decided, as a $50 billion company, to put $20 billion into data. They did that, and as a result, today that $50 billion business is worth $207 billion. The other encouraging aspect is the three largest companies that went public this year have already, as tech businesses, have already broken into the top 50 largest companies on the stock exchange. Now, acquisitions are another important area for us to think about. A couple years ago, we talked about the fact that there needed to be super consolidators in the market. The US had FANG, or now with the various name changes, maybe it's Mana. China's had BAT. And in India, we created our moniker, Mr. Fatbug. Now, Mr. Fatbug was our representation of the fact that there would be Indian tech companies, traditional Indian businesses, foreign tech companies, all looking to acquire companies in India. Sure enough, that's what happened. Over the course of this year, we've seen Reliance, Tata, Flipkart, Amazon all make acquisitions, and many others. The other part that was interesting was that we actually saw new age companies acquire traditional businesses. As new age companies realized that they could look for customers in all areas, they realized that old age businesses actually had the customer base, and the new age companies had both access to capital as well as equity currency to make that. That's going to continue to happen over the coming years. Finally, the last area that we look to generate liquidity are secondaries. And this year, we've already seen $1 billion worth of liquidity through secondaries, and we expect that to continue. Act 2, we'd like to talk a little bit about the changes that have taken place over the year, or over the years, actually. And India is a country where changes take place in parallel. In other markets, we had, or those economies had the benefit of seeing organization take place first, then urbanization, then growth in per capita GDP, and finally tech came along. In India, all of this is happening at the same time. So over the last few years, we've seen tech penetrate to 58%, while organization has gone from 2% to 12%, while urbanization has taken place, while we've seen a rise in GDP. All of this, of course, in traditional Indian style, has been supplemented by a lot of noise. Now, on the tech penetration side, this has clearly made a difference in impacting how companies are able to address consumers. Nothing accelerated things more than the pandemic, and as the statement goes, necessity is the mother of innovation. We saw a massive growth in Dunzo, our quick commerce business, which went from about $61 million in AOV, annualized GMV, to about $170 million in annualized GMV. Now, this growth in the business was further supplemented later by the implementation of mini warehouses. These mini warehouses allow Dunzo as a company to now deliver products to you within 19 minutes, and it's changing the very way in which people are going to consume their daily needs. Organization, fragmentation, chaos is never more present than in the food supply chain. If you look at how food is transported from a farmer to a consumer, it changes hands about 7 times along the way, and it doesn't change it in a very efficient way at all. Waycool stepped into this mess and actually put in place technology, process, automation to ensure that that 35% wastage that we saw is reduced to 1%. On the back of that, they've been able to grow their revenues from about $40 million to $135 million. Along with that, they've also built a series of brands that are being distributed through multiple channels and which is supplementing and growing their margins. Urbanization. We used to think urbanization meant move from a village to a city. Now, again, the pandemic showed us that urbanization has lots of issues, and once there aren't jobs and there are challenges, people tend to migrate back. Over the course of the last year, about 120 million people moved from urban centers to rural areas. Now, therefore, we realize that urbanization is less about being in a city, but more about having access to income opportunities. With work from home, and I'm assuming many of you are actually sitting at home right now watching this, we're finding that people can get their jobs and get things done even in rural locations. Furthermore, we find that consumption is happening now in those areas as well, and companies are addressing that opportunity. 400% growth in data consumption, 50% increase in food delivery, 54% growth in digital transactions, and even groceries are growing in that area. Finally, consumption and per capita GDP growth. GDP growth, quite honestly, has been less than exciting. We've grown about 8% per year over the last 15 years, which when you take inflation doesn't really help a lot. However, what's now supplementing it is credit. Now, if you look at it, we had a growth of about 2.3x in the last 4 years in terms of personal loans. The majority of this is coming from new age fintech companies. And as we have a very young population, we're going to see that that base will continue to access it. This population is going to continue to look to consume premium and differentiated products. Here, many of you may remember the lines that were built up on the drive to IKEA when they first opened in Hyderabad. Today, we're at about 200 Starbucks in the country, and it seems like every time they open, there's a large line there. And even Apple's getting in on the whole party with the launch of their online store in India in 2020 and their physical store here in Mumbai later next year. Now that we've understood a little bit about where the changes have taken place, we wanted to talk about the building blocks that are going to help us go build going forward. As a tech investor, we tend not to talk a lot about infrastructure. However, it is the backbone that powers how logistics and commerce take place. If you look at it, today 18% of the total cost of production goes in logistics versus 9% in China. And this is because, unfortunately, our roads are not very good. From 2014 to 15, we were building roads at 16 kilometers a day, and we had about 91,000 kilometers of roads in the country. By 2021, we got to 137,000 roads, which is much more than we'd done in the previous many years, because we increased the pace of production to 37 kilometers per day. Over the next 5 years, there's an expectation that this rate of adding roads should grow to 100 kilometers per day, and hopefully we should complete the Golden Quadrilateral. All of this should help us bring this cost of logistics down and therefore help the margins of many of the e-commerce companies in the market. We have to talk about the clicks as well. It's not just about the bricks. And here, the digital stack and the finance aspect of it has been tremendous in terms of its impact in the market. In the 3-year period from 2016 to 19, when UPI was launched, we saw 1 billion transactions. In the month of October alone, we saw 4.2 billion transactions on UPI. UPI represents about 84% of all digital transactions in the market, and this year is set to hit about $1 trillion of transactions with about $40 billion worth of volume. Now, all of the digital financial payments that are taking place both on the consumer and from the government side is clearly impacting businesses as well. Paymate, as a company in our portfolio, went from about $45 million in revenue to nearly $200 million in revenue as a run rate basis this year, because companies realized that they needed the opportunity to be able to make digital payments. It's a complicated process to manage GST payments across states, and Paymate provides a solution. This translates into about a $11 billion transaction processing value through the system. Now, healthcare is another big area that the government worries about, and quite honestly should. We have one of the worst patient-to-doctor ratios in the world, and therefore we need technology solutions to provide healthcare access to the breadth of the country. The government launched eSanjeevani as a platform, and the encouraging numbers are that we've seen about 13 million teleconsultations on the platform to date. About 90,000 patients access it on a regular basis. The government also stepped back and looked at some of the policies and acts in place and amended the Mental Health Act, in 2017. They did 2 big things in this amendment. They decriminalized the act of suicide, acknowledging that it's a mental disorder, and they made it mandatory for insurance companies to cover mental disorders. On the back of this, we started to look at the mental health space, and we understood that 1 in 6 Indians actually suffer from mental disorders, and 85% of the people do not get care in time. With that knowledge and that understanding, we invested in InnerHour, and the company has seen about 2.3 million downloads. They've found a channel in businesses that have understood that they need to take care of their employees and have been able to grow what we call the alternate payer base, about 20x over the last year to 40 customers, 40 businesses that are now paying to ensure that their employees' mental health needs are met. Capital is the second building block we wanted to talk about, and it's flowing like never before. Overall, if you look at it, in the last quarter of this year, $10 billion went into the venture capital industry. That's about equal to the amount that went into all of the previous calendar year. We've seen that for every dollar invested in Chinese tech in the quarter ended in September 21, $1.50 came to India. We don't really like India-China comparisons because there's so much different between the 2 markets, but it's the first time we've actually beat China on one metric here. Now, on the venture side, we've also seen a large amount of capital come into the market. In the 3-year period from 2012 to 2014, on the early stage side, we went from 300 deals to currently today about 700 deals. We went from capital invested of about 510 million to about 1.8 billion. We went from number of investors at 732 to about 1,662. What that's meant is that there is more deal flow, more action at the earlier stage of the ecosystem, and more entrepreneurs and companies helping out there, which meant that for us, as we looked at our risk-return equation and our target return at an equal level, we realized that we can start investing slightly later. And this has been exciting for us as we've been able to participate in the growth of some from more established businesses. Finally, talent. Talent is the backbone of what makes all of this happen. Now, growing up as a kid, I think the statement made to everyone was, you have to be a doctor or an engineer. Now it's interesting to see that parents are probably talking to their kids and talking about the fact that their neighbors' kids are CEOs. And so, therefore, this is not lost, and it is impacting lots of companies at all ends of the spectrum. McKinsey, for example, is losing employees to startups. We're finding that educational institutions are willing to now come together to foster and grow entrepreneurship. We're also finding that the profile of business leaders is changing. We're seeing that it used to be the promoter. It used to be a legacy business that went public. It used to be that they had been doing it for decades before they were actually able to reach the public markets with any scale. Today, these are first-time entrepreneurs, many times coming from rural areas and finding their way through raising capital, identifying customer needs, and building and growing these companies that are now becoming large and public. The repeat entrepreneur. It's a University of Chicago study showed that second-time entrepreneurs, regardless of whether they succeeded or failed, tend to do twice as better than first-time entrepreneurs. That's really important because it's taken us a while to build an ecosystem, and there was no shortcut to it. You just needed time to go. But we're there now, where we now have second-time entrepreneurs that have built companies, actually successfully exited them, and are now at it again. Also, these entrepreneurs are giving back to the community. They are investing their capital that they made in their previous existences, and they're coming together as part of angel networks and cultivating and growing. So talent is coming back and getting extremely well supported. This has also meant that founders are being extremely resilient. In our portfolio alone, we saw that when the pandemic hit, Flinto Class, which was a business that was providing curriculum and materials to preschools around the country, was delivering it to 320 schools all around the country. When schools shut, they had no one to deliver to. So they evolved their business and actually moved to providing it to people at home. Now, from this, they were able to grow their business from basically a place where they'd shut down to about $30 million in bookings. Now, from that data, they've now found out that they've created clusters where they have about 1,500 clusters where there are at least 25 kids. So what that means is when the markets open up again, those clusters where there are at least 25 kids who are subscribed to the Flinto Class at Home product are a ready base of kids to actually come to a Flinto Class school. And that's what we're going to see happen, and that's where this business is poised to go and become the largest preschool in the country. Our entrepreneurs have also had the opportunity to take inspiration and learn from each other. Rebel Foods, which we'll talk about in a few minutes, built a platform that allowed them to run multiple brands in the food industry. Bombay Shirt Company has done something similar in the apparel market. By focusing on custom apparel and focusing on a platform that allows for that, they've been able to grow their revenue through the lockdown back to about $6.4 million in revenue. And by focusing on operating metrics, they've been able to actually ensure that in an industry where the average return rate is about 30% for apparel, because it's something that people are spending a lot of time and energy in designing themselves, they're invested in it, and their production quality is high, their return rates are only at 2%. Act 4, we want to talk about quality and just service and the change that's taken place there. We've often said that we don't like the idea of Jugaad, and Jugaad is out, even from a customer mindset, and quality is in. New age businesses are killing legacy brands on service, and the brands that aren't recognizing that are going to be hurt. Gone are the days where you're going to stand at a bank in a long line while someone plays solitaire on the other end. Fintech companies are creating access to the bank in your pocket, and they're making it extremely easy for you to transact and get whatever you need. Consumers are also showing that they care about the fact that you as a brand care about what they want. In feminine care, for example, the idea of a pad that's going to help you win the Olympics doesn't make a lot of sense to a consumer. They need a product that works. And by creating a product that works, Nua has been able to generate a 40% 12-month retention for their business, 48%, sorry, which compares, incidentally, with 50% that Dollar Shave Club had. As a company, they've also decided to take the approach of listening to their customers. This is on their social media feeds. One of their customers said they would really appreciate a heat pad. The companies looked into it, understood it, and eventually figured out that, yes, it made a lot of sense. They designed it, developed it, and today 17% of their revenue comes from new products that have come through conversations like these. Aspiration is another aspect of what brands need to understand that consumers want. Melora always had the ideology that women wanted everyday jewelry. They wanted something that was going to be aspirational, and they wanted to reach customers in a multi-channel basis. They have an online platform as well as a physical store. The physical store also has allowed them to grow revenues when the lockdown hit from basically zero to today over $50 million in revenue. Transparency and trust is another hallmark of what customers want. This is a picture of 3 medicines. This is a branded medicine, this is a generic medicine, and this is a brand called Good Aid, which is our company Zeno's brand. They all look the same. They're all packaged the same, they all have the same information, and yet the prices of all of these will be very different for a customer depending on who's selling and how they're selling it. Zeno helps customers understand this and break down a cost of 100 rupees down to about 24 rupees and save customers between 40 to 80% on their cost of medicines. On the back of this, the company has grown from 43 stores to 114 stores and about $20 million in annualized revenue over the last year. Our new India is both bold and confident. If you look at what's happened over the last few years, the Indian cricket team, although some days it has good matches and some days not so good, but is no doubting the fact that they are now molded in the aggression and confidence of a captain and a team that just believes that they can accomplish a lot more. In that context, we've also seen the values of these businesses and the values of the IPL, for example, increase tremendously. When the first IPL auction took place, a team went for $68 million. More recently, in the current auction that took place, the Lucknow team went for $950 million. If you look at how that compares to global teams in other leagues, we're moving up, and I think that's going to continue. The change in India has also taken place both in the business side as well as in movies. We've seen Falguni build a fantastic business as a woman entrepreneur in Nykaa. We've seen new shows come out modeled around the ideas of Sex in the City and concepts that perhaps may not have been promoted as openly earlier. Indians are also joining the global stage. We've seen here another Indian joining the cast of actually Sex in the City, Geeta Gopinath, as the first woman chief economist of the IMF. We've seen Disney now release a movie with an Indian-American lead called Spin. So India is making its presence felt on the global stage. As this has happened, we've seen that the companies have moved from emulating and imitating companies from other markets to actually innovating now. And we've found that the Indian versions are now being marked as the companies that people are copying elsewhere. In countries in South America, in Africa, we're finding people talk about we are the rebel of XYZ country, we are the Misho ABC country. So Indian businesses are now really innovating and being recognized globally. Furlenco is an example of that. We actually created the furniture rental space out of India. It's a business that today has a 47% asset IRR, 137% equity IRR. We have a $90 million asset base, and we have a business that's generating about $34 million in subscription revenue. Rebel, as I mentioned earlier, a business that really defined how to build a cloud kitchen, or how to build cloud kitchens around the world, has gone from being just in India about 4 years ago to now operating in 10 countries around the world and continue to expand its presence in many others. We've gone from 138 kitchens to 465 kitchens, and along the way grown to about $150 million in annualized revenue. Finally, we want to talk a little bit about ESG. This is an area that's really important to us. We all live here, we all understand, and the very fact that it's raining here today in December is reflection of the fact that we better start thinking about the world outside of us. This year in November of this year, we saw in Delhi that you basically couldn't see. In Bombay, as I just mentioned, it rained in August, it's raining now. Chennai is still being battered by rains. This is a reality of life. If we're going to invest in companies moving forward and going to hope to make a change, we have to consider the effects that they're going to have on the environment. And this is not just us saying that it would be a nice idea and a good thing to do. It's actually customers also saying that. When Ola launched Ola Electric, in one day, they sold $80 million of vehicles. That is equal to the total number of scooters sold in a day by everybody else. So clearly customers, whether it's aspirational, whether it's for the environment, they like the idea of associating with doing the right thing. And I think even legacy brands are understanding this. 5 years ago, we talked about the fact that Reliance went from oil to data, and as a result, ended up creating a ton of value. Recently, they've made the statement that, again, they're going to move from oil to energy and renewable energy. And again, if history were to repeat itself, we should expect to see a lot of value get created there as well. ESG compliant businesses are not just nice for the world, they're actually valued better. Here, the BSE GreenX, which measures companies that are higher on the ESG compliance index versus the Sensex, has outperformed it over the last year. And finally, from our lens, we look at 4 parameters when we're evaluating a business: technology, brand, consumer preferences, and sustainability. On the sustainability side, we break that down into responsible consumption, innovation and differentiation, and diversity and inclusion. We measure all of our businesses on these parameters, and we measure ourselves on an ongoing basis as to how we're improving. And we're proud to say that our company CityFlow, which handles daily commute, has actually been able to reduce 18,000 metric tons of CO2. They've taken 15,000 private vehicles off the roads and will continue to grow those numbers over the years. So from our view, profit and impact are not mutually exclusive. And this is something that we should keep in mind as we continue to invest. Finally, I want to talk a little bit about where this could all go. We have a habit of saying that we're in the business of the what if. And as part of that, we like this quote: "I skate to where the puck is going to be, not to where it has been." And I think that amply looks at how we need to think about where things are going. Back in 2000, people wondered, what if we could video chat? What if we could navigate without asking anyone for directions? What if we had all the information at our fingertips? In 2010, we've had that. In 2020, we have even more. And technology made all of these things possible. It gave us access to information, it gave us connectivity, and it gave us a system and a platform where it's never been easier to start a business. In 2021, we want to take a look at what are going to be the possibilities that power the next shifts in the way we live. So what if? What if India became a global manufacturing hub for electronic vehicles? What if India became an alternate manufacturing hub for the world? What if India became the human capital hub to lead the Web3 revolution? What if India became 100% literate by using technology at scale? What if India exported its culture to every part of the world? What if India built the world's largest predictive commerce platforms? And many more what ifs. As you can tell, some of these what ifs are happening right now in front of us. And that's honestly why we believe that the party is just getting started. You're invited. Thank you.